Hello, welcome back to International Finance. So we're going to change things up a little bit. Instead of focusing directly on options and foreign exchange, first we're going to look at foreign exchange and derivatives in part one. And then in part two, we're going to study options. So our last lectures, we've established the balance of payments and Brexit. We spent quite a bit of time to understand the international monetary system. And in our very last lesson, we looked at the corporate governance issue. We said that because of dispersed ownership, it's great for diversification, wonderful for capital raising, but difficult for monitoring. And so we talked about how that gives rise to an agency problem. And then we also looked at different solutions that arise to handle that agency problem. We talked about the discipline of debt, corporate boards, the market for corporate control, activist shareholders, quite a bit. And what we came down on was the notion that, yes, all of these tools are helpful, but there's no tool that's perfect. This lecture, we're going to look at the market for foreign exchange and derivatives. We're going to talk quite a bit about how the market for foreign exchange operates. So we're going to look at the spot market, we'll look at cross rates, and then of course, we're going to move on to forwards. We're going to talk a little bit about the difference between forwards and futures. And the goal is for us to establish a more familiar background with foreign exchange and with derivatives in general. And once we build that base, we'll look at options. So we have our present value equation. And the way that we're going to think about foreign exchange affecting value is really through the numerator, through our free cash flows. Now, obviously, in our denominator with our weighted average cost of capital, we know that the actual cost of capital will be affected by sensitivity and exposure to foreign exchange. But for now, we're really going to think about this as a cash flow issue. So we're going to look at different ways in which the value of a cash inflow or an investment decision is going to be affected by foreign exchange. So let's establish, if we remember from our balance of payments lecture, we found that as US companies import, they're going to supply dollars to the Forex market. The intuition was that they're going to be sending dollars to the market so those can be converted to local currencies to pay for these imported goods. Similarly, we said that as US companies export, others are going to demand dollars from the Forex market to pay for these exported goods and services that the US companies need to be paid for in dollars. So what does that mean? It means that all around the world, as we have this exchange of commerce and this flow of capital, we have countries supplying and demanding foreign exchange from the Forex market. And that's pretty much reflected when we look at the large shares of FX that are being traded around the world. So these are the shares of global foreign exchange that are from the Ewan and Resnick book. The key takeaway is that we see that there's quite a bit of heterogeneity. There's quite a bit of diversity in terms of the countries that are represented in the FX market. So we keep saying FX market, and I just want to establish that this is the largest asset class that we have. By trading volume, the Bank of International Settlements, BIS, reported that the FX market had a daily trading volume of plus 6 trillion USD in 2019. Almost half of that volume is concentrated in derivatives. Derivative securities are named that because they're going to derive their value from another traded security. So in our examples today, we'll think of the forwards and the futures as really capturing this derivative concept because their value is going to be derived based on our expectations of where the spot exchange rate will be. Okay, so we've got this really big market of 6+ trillion traded every single day. That market actually consists of several different markets within that large asset class. So we have the spot and forward market. Now, the spot and forward market is relatively opaque. The spot market, we're going to have large trades. These are going to be over-the-counter trades. The forward market, also large trades, over-the-counter trades. Banks and non-bank dealers are going to serve as market makers for other commercial banks, investment banks, companies, investors, etc. The way that it works is we have brokers that don't have inventory, but do the job of matching supply and demand. And then we have banks that are going to basically net out their positions between each other for either speculative reasons or liquidity reasons or whatever. But generally, we'll think of a lot of these flows as sort of speculative, where investors are anticipating how a price will move. And based on that, they go to their bank, they go to a clearinghouse and say, hey, I need to exchange some Forex. The forward market, these are really contracts that are tailor-made for the specific needs of a client. That's a plus size because obviously if you have a very unique cash flow situation, or if you're a firm that has all different kinds of liabilities and receivables across the world, then you may want a very special and tailored solution. The thing that'll make this challenging is because these are two-party contracts, from our perspective as outsiders, it's going to be very opaque. We're not going to have the luxury of being able to look on prices that are listed on an exchange like we do for futures and for options. So when we think of futures and options, these are going to be standardized contracts that are fairly large. The upside is that because they're standardized and because they're exchange listed, it's going to be relatively easy for an investor or for a firm to figure out the appropriate price. The downside is that because they are large and they can't be customized, if you're a firm that's going to be using a future to hedge, or if you're an investor, or if you're an agricultural supplier, if you're anyone in the market that's going to be needing access to a tool for your commodity risk or your currency risk, it's going to be a little bit hard to deal with the fact that these come in predetermined sizes. So what does that mean? It means that if you think about an option contract for equities, we're talking 100 shares. So if you apply that same concept to commodities or to currencies, maybe you don't need 500 bushels of corn. Maybe you don't need 1,000 hog heads or something like that. So this is sort of the complexity. The futures and options are going to trade on exchanges like the CME, like the Chicago Board of Trade. So these are all going to be listed, and it's wonderful because we can see their prices. The last part of this market that we won't talk about are currency ETFs. And what's really nice about the currency ETFs, the exchange traded funds, is essentially we're talking about a currency portfolio, so a basket of these different currencies. It could be one currency or a basket of a couple different currencies to replicate exposure to the EU or to emerging markets or to all different parts of the world. What's nice is that because these are listed on exchanges, the shares, the fractional ownership of the ETF is going to allow investors and firms to manage their exposure with way less capital. The futures and options are going to be relatively large contracts. The spot market, we're talking a typical trade size of 10 million. Forward contracts, also very large. So the ETFs are going to provide an opportunity for an investor to essentially hedge or gain exposure to speculate on currency and on commodity in a way that the other aspects of the FX market don't allow. So that's kind of a cool thing to note, but it's not something that we're going to focus on as we go through with our lesson today. Okay, so let's look at arbitrage. Suppose that the spot dollar-euro rate equal 150, i.e. it costs $1.50 to get 1 euro, and that the spot dollar-pound rate equal 2, i.e. it costs $2 to get 1 pound. What must be the cross rate? So we've done something like this before in our previous lectures where we looked at real prices to show that yes, when we actually look at the cross rate within FX markets, the cross rate is a way of saying if we're looking at two currencies that aren't the dollar, because a lot of our trades, all of our trades are going to go through the dollar because the dollar is essentially a reserve currency for the FX market. So when we look at these cross rates, and we've looked at the cross rates before, what we found is essentially this, that really there's essentially a no arbitrage condition. What does that mean? It means if we do the algebra and solve for what's implied for the spot rate for the euro to pound, we'll find that £1 should cost us 1.33 euros, according to these rates. And again, in solving this before, we assumed that there was no arbitrage opportunity. That is, that there's no opportunities for us to earn a risk-less profit. What would arbitrage look like? What is a risk-less profit? A risk-less profit means that without putting any capital at risk, we're able to earn money that we shouldn't be able to earn. We're able to arbitrage or essentially game the prices. So let's look at what happens if we have a deviation from this no arbitrage condition within our FX market. So you're the financial manager of a small multinational company, and you observe the following exchange rates. So we have these exchange rates. We have €1 trading for 85 cents. We've got £1 trading for $1.60. And we've got €2 trading for £2. First, are the spot rates consistent with no arbitrage? So what are we going to do? Our first step is going to be to solve for the implicit cross rates under no arbitrage. So as we solve for this, what are we going to find? Well, as we do the algebra, as you set it up and work through it, and again, even though the answers are here on the screen, please take out a pen and piece of paper or on your computer. Make sure that you understand how to set this up and that you can solve for it, because that's the expectation. So as we solve through this, as we work through it, what do we find? We find that if we take the spot rate for the dollar to pound and for the dollar to euro, it does not imply the spot rate that's given here for the euro to pound. The spot rate that's given in the market, or the spot rate that's being offered, says that £1 should cost me €2. But if I use the spot rates that are available in the market to solve for the cross rates under no arbitrage, what I find is that the market price is saying that £1 should cost 188 euros. So there's a difference here. We can see that the spot rate that's being offered violates the cross rates under no arbitrage. So an investor can earn a risk-free profit by trading across these exchange rates. And we'll look to see exactly how. So given the rates on the previous slide, how can we earn a risk-less profit? Step by step, we're going to go from the dollar to the pound, from the pound to the euro, and from the euro back to the dollar. Okay, so suppose that we have $1 million to trade. How are we going to be able to take our million and earn a riskless profit? And again, the numbers that you put here, any number that you put is going to earn a riskless profit. So we're going to use $1 million because the numbers are going to be nice and big, and it's going to let us kind of have a good sense of what's happening. So let's work through it. First, let's take our million and convert it into pounds. So given the exchange rates that are available, our million will buy us 625,000 pounds. Next, we're going to take those pounds and convert them into euros, given this rate that we know should not exist. Because again, as we saw in the previous slide, it should be that £1 is worth 1.88 euros, but we're finding £1 is worth 2 euros. So let's plug it in. We plug it in, we plug in our 625K, and that yields 1,250,000 euros. Our last step will be to convert those euros back to dollars. The reason why we're doing this is because we saw that if we use the rates that are implied by the market, then there's no arbitrage. But using the rates that are being offered, there's a way for us to beat the system. So what do we see? As you set this up and as you do the math, I hope you pause, I hope you work through it, and in doing so, you'll come across this same answer. What you'll notice is that the 1 million that you started with has now grown to 1 million plus. We earned 60,000 plus profit doing nothing. All we've done is go from one currency to another. We haven't made any real investment decisions. There's no risk that's involved in this because, again, these are exchange rates. So we can always go in and out of these. So that return that we made, the 6.25% return, this is because something is broken. And what's broken is that one of these exchange rates is not priced correctly. To put our return, our 6.25% return in perspective, our risk-free return, it's on par with what you would get for the risk premium for the S&P 500. So this is a lot. We shouldn't be able to earn this much doing nothing. In equilibrium, if investors did this over and over and over, and they would, eventually we would observe that the prevailing market rate, the spot rate for the euro to pound, would actually eventually get to 1.88. So what's the takeaway? The takeaway is that when we have these arbitrage opportunities, we're going to think of the market as efficiently responding to them by basically pricing them away. And that idea of there being no arbitrage is going to be something that is very fundamental to our ability to actually price derivatives. And it's going to be something that we kind of think of as sort of playing a big role in the FX market. So in this example, let's take that same concept and apply it. You're a currency trader, you've got $1 million USD. The dollar-euro exchange rate is quoted to you as $1.60 equal 1 euro. The dollar-pound exchange rate is quoted to you as $2 equals 1 pound. If a bank quotes you a cross rate of 1 pound equal to 1.2 euros, can you make a risk-free profit? If yes, how much profit can you make, and what is the risk-free return on your investment? As you set this up, I suggest that you do what we did to start this. You find the implied cross rate for the pound to euro. And if you find that the implied cross rate is not the cross rate that's being offered, then let's figure out how to take our $1 million and send it right on through the system. So we'll go from $1 million to either euros or pounds, and from there to either pounds or euros, and then back to dollars. Okay, how is this market structured? So we said that now that we've kind of established this sort of no arbitrage condition, and we have hopefully a better understanding of what we mean when we say arbitrage, we've actually just looked at an arbitrage strategy. We showed how using $1 million and having nothing at risk, we can actually increase our return on investment by essentially doing nothing. So we can arbitrage the market. Now let's understand a bit more about the market structure. So we have the spot market for FX. Here we've got a spot rate for the dollar to euro equal to 150, i.e. it's going to cost $1.50 to buy 1 euro. So how does this work? Well, with the spot market, we agree to buy or sell today at the prices that we observe today at time t. And the trades are going to happen right now. And again, this is an OTC market. This is an over-the-counter market, meaning that the trades aren't happening on some listed exchange where all the market participants are able to view the price. And how is it going to work? Well, it's going to settle via a clearinghouse because, again, it's not going to settle through an exchange. We also have our forwards, which, as we said, were also OTC and non-standardized, and that's different from our futures, which are going to be priced on exchanges and standardized contracts. With our forwards and our futures, we're agreeing to buy or sell at time t at a pre-specified price. Our worry, we'll get to when we get into the second part of the lecture, is that the price we agree on today might be a bad price tomorrow. But what's interesting about the forward and the future, another key difference that we'll talk about later as well, are how they're marked to market. So for the forward, we're not going to have anything that happens, no delivery of assets, no cash settlement until the contract matures. And for our future, every day we're going to be marking to market as we settle this, because again, these are exchange listed securities. So the last instrument that we have within this market that we'll talk about are options. And here, what's important is that we have the right to buy or sell at a pre-specified price on some maturity date, but we're not obligated to buy or sell at that pre-specified price. So in that sense, we have the option, and that option is going to be incredibly valuable. So we'll discuss options in detail in our next lecture, but hopefully it's clear that across this market structure, we have different instruments and different markets that are all happening. So let's define how we're going to trade. Let's look at our long and our short positions to make sure that we're all on the same page with language. Long means we're buying. So if you buy anything, if you buy the currency, you are long the currency. You've taken a long position in the currency. Short means selling. So if you sell anything, then you're taking a short position in the asset. And again, this applies to currencies, options, stocks, bonds, forwards, futures, swaps. Pick a thing. This is the language that we're going to be using. All right. Suppose Bank NYC suspects that the pound is overvalued and would like to sell 100 million pounds today. That is, the price today, they think, is higher than the expected price in the future. And so just to make sure, again, we're also clear with the language, we've got our time subscript T, we've got E, and then with E, we have an expectation operator. So we're taking an expectation, the expected price for tomorrow or a year from now, sometime in the future, it's going to be lower. And this could be for many reasons. It could be that we have some news or some forecast or a model. We could have biased expectations, but for whatever the reason, we would like to take a short position on the pound. How are we going to do that? Well, Bank NYC is going to get in touch with a market maker via a clearinghouse. So what does market making mean? Let's make sure we kind of understand. The market maker is ready to buy and sell the currency. They're ready to make a market in the currency, not out of the kindness of their heart, but for a profit. How are they going to earn a profit? Just by buying and selling. But they're going to earn a profit with the bid-ask spread. Suppose the exchange rate, the spot rate in the market for the dollar to pound is 2. That is, 1 pound costs $2. The market maker, who we'll call Bank London, is willing to buy the currency at the bid and sell at the ask price. Suppose that the bid is $195 and the ask price is $205. Okay, I'm buying at the bid and I'm selling at the ask. Buy low, sell high. Hopefully we can automatically see that there's a spread between the price that the market maker is willing to buy and then the price that the market maker is willing to sell. That spread, the difference in prices, is called the bid-ask spread. So in our example, our bid-ask spread is 10 cents. That's massive. You'll never, hopefully you won't see a bid-ask spread that big for Forex. But that bid-ask spread is a very common measure of liquidity. And again, liquidity has so many different meanings and so many different definitions in finance. Here, when people talk about liquidity within the security market, specifically when you're talking about a bid-ask spread, you really mean, is it easy for me to trade the security? Here's why. That bid-ask spread is going to give the market maker a profit. That profit is going to compensate the market maker for inventory risk and also for information asymmetry. Inventory risk is the worry that I'm going to be holding on to an asset that's going to fall in value. So you can imagine because the market maker is making a market in, let's say, dollars, or making a market in this example in pounds, that they've got a ton of inventory. They're sitting on a lot of this currency. Well, if you know something that the market maker doesn't, there's a good chance that that information that you have, you're going to trade on. So to protect itself from basically this information asymmetry, the market maker is going to increase this bid-ask spread. So this is part of the reason why we think that it does a good job of capturing liquidity, because if it's very easy to kind of buy and sell and get in and out of a market, then essentially I really don't have too much information asymmetry for that asset as well. The bid-ask spread is going to increase in volatility. So when the underlying currency or commodity is very volatile, the bid-ask spread, the market maker is going to widen it. Same intuition. There's a lot of volatility, a lot of uncertainty. The market maker wants protection. It's going to increase in information asymmetry, like we've been saying. And not surprisingly, it's going to fall in competition. So when there's more competition between market makers, that bid-ask spread is going to be smaller, because obviously if I'm competing, I'm not going to be able to extract the same rents from the market that I would if I have essentially a monopoly. Okay, so for now, let's assume that the bank trades at the midpoint of the bid and the ask. So bank A is London and bank B is New York. Okay, the current exchange rate, we said the dollar to pound exchange rate is 2. So 1 pound is going to cost me $2. And a trader at the currency desk of Bank A buys 100 million from a currency trader at Bank B for 200 million. Why are we not saying what these banks are? Well, because this is an over-the-counter market, we actually will not observe who these banks are. So the banks are going to settle with each other via a clearinghouse. And there are many, many types of clearinghouse. The two here that I've mentioned, CHIPS and SWIFT, are some of the oldest and most widely used, but there are many more. Okay, so we've got Bank A, our Bank London. We've got Bank B, our Bank New York. Bank A sends 200 over. Bank B sends over 100 million pounds. Okay, so Bank B thinks that the pound is overvalued. What did Bank B do? Bank B shorts the pound and longs the dollar. They sell the pound, they buy the USD. Why? Well, if they're expecting the currency to depreciate, then they're expecting the price of the pound to fall relative to the dollar. So in dollars, the price of the pound would fall. So today, it takes $2 to buy a pound. Tomorrow, it would take $1.90. The day after, $1.70, $1.50. This is the expectation when we say that the price would fall in dollars. What does all of this look like? Honestly, it's going to depend on how the currency is quoted, if it's a direct or indirect quote, a European or American quote. It's also going to depend on the execution price, so the bid and the ask spread. And we'll examine both the quotes and the bid-ask spread next. So the FX quotes. Notice what the currencies are quoted against. So this is an exhibit from the Ewan and Resnick book that has basically a good sample of exchange rates. What you'll see is that they're quoted in US dollars and per US dollars. And this is super common, as the US dollar is the currency that conversions will go through. Meaning that if we want to trade pounds and yen, or if we want to trade Canadian dollars and krona, if we call up our market maker, we call up our investment bank, what they'll do is go from krona to dollar and then from dollar to Canadian dollar. So it's the currency that the currencies will pass through if we're using institutional language. Also note how the currencies are quoted. So not only is everything written against the dollar, but notice how they're quoted. They're quoted in USD, and that's a direct quote. where the price of the foreign currency is in dollars. So you can think of dollars being in the numerator. There's also an indirect quote where it's quoted per USD. So this is the price of the dollar in a foreign currency. So here are the foreign currencies in the denominator, in the numerator, and the dollars in the denominator. And of course, our direct quote and our indirect quote are going to be reciprocals. And that should make sense, because if they weren't, then a really smart investor could do what we did to start the lecture, looking at the cross rates. If they're not reciprocals, a really smart investor is just going to take everything that they have access to buy one currency in one market and sell it in the other. So let's look a bit more at these quotes.